Hello, everyone. Welcome to today's session. Let's get underway here. Start off with the current market conditions, talking about our long-term market perspective, and still in our overall bull market, we're sitting at a bull market rank of 21.97. This is as high as I've seen this. I've seen it a little bit higher. I've seen it above 22. As I mentioned in this morning's update, about 3 times maybe in the last 10 years or so. So it definitely does not get to these levels very often. It doesn't mean it can't stay at an elevated level, particularly if it starts to retrace. We get a market downturn. It's this indicator here. It's very slow moving, as I mentioned before. We'll just reiterate this one right here, since this is the biggest risk in the market currently, and that is that we are at the upper end of this trend. Doesn't necessarily mean that we can't continue to head higher, but the magnitude of the trend without a retracement is probably going to be problematic here moving forward. I wouldn't be a bit surprised to see some backing and fill in. We'll look at that S&P 500 chart here in just a minute, and I'll show you what I'm talking about. Shorter term signals, we're seeing momentum still in that upper range. We're seeing breadth still in that upper range, and then sentiment way up in that upper range. So things are still quite bullish. They're quite complacent. Even though, even we get a down day or any kind of a sell-off right here, we're seeing S&P 500, and this is only sitting at the at this 1%, less than 1% right here, and a little bit of a move. Now, a couple of things we want to talk about and be watching for is this pattern on S&P 500 has created pretty identifiable support ranges right across here, right around that 515 range. You can see it's been back. We talked about it pulling back, finding some support, and then ultimately retesting that high. That's what it's been doing really since, really going back to about right here. So going back to January, really the beginning of the year, we've just kind of had this really slow stair step higher. Here's our support. Okay, if you look at, draw a line right across here, it broke out, it retested here, broke out, retested, and really then there's this one a little bit right through here and then right through here. So really these areas now, we've got, so the first test that I'd be watching for is this one that we're at right now today, watching to see if we hold up above these levels. If we can't hold this level and we dip back down to this 506, then we're going to have a condition that we haven't seen in a while, and that is we get new resistance. Okay, we haven't had that yet, and we don't have it yet as of today, unless we, if we find some support and we start to move higher, then this area right here should be holding. If it doesn't hold, then we've got a scenario where it breaks down and now we run into resistance. This will be the real first time that's happened, if it does happen, and that's one of the first clues that we want to start watching for in a trend reversal, is when we start to break down through zones. We start to break down through support resistance zones, and we start to break down through Fibonacci zones. We've got a long ways away before we run into any Fibonacci support or resistance. And as I mentioned before, we've got April now. We'll see how April turns out, and then we're going into May, and then we're going into summer, and that traditionally is a slower / down month, especially since we've had this really big run up right here. We could be approaching some seasonality with the markets as well. So I want to talk about this a little bit more in detail today, because we're right at this level where if we are going to reverse, and really it has been, this entire move right here, it's been driven by anticipation of the Federal Reserve cutting interest rates. It's been driven in anticipation of interest rates moving lower and bonds moving higher, and AI creating efficiencies. The market still believes that, at least as of right now. We'll see if that continues to be the case. One of the other things that could be significant here moving forward, and that is taking a look at what bonds did yesterday, both TLT and SHY. TLT down yesterday and then down again today. Remember what that means. When bonds are moving down, interest rates are moving up. So this entire move that we've had now, really, we had bonds move up in November, December, January, and they haven't done anything all year long but moved back down again. So that's, that is Part of that has to do with the inflationary numbers. They continue to be pretty high. Therefore, the Fed has paused in making their decisions. They just keep kind of anticipating. They kind of keep guiding and trying to give some insight on what's happening. This is not a good thing for the markets to be moving higher. We want to see bonds improving, both the short term and the long term. Look at the short term bonds now. Short term bonds are starting to come unglued right here towards that downside again. Obviously back in that downtrend, and potentially could get a bounce right here. There's some support levels that are going to start to come into play. But remember the issue with short-term bonds. The issue with short-term bonds. Now this is kind of a macroeconomic perspective. It's very theoretical, but it is essentially the way that markets run currently, and that is based on Federal Reserve and money supply. So interest rates play a big part, and the bond market and bond yields play a big part. Now, we've talked about this before. We don't want this is an inverted yield curve. Inverted yield curve, when we have higher interest rates on that short end, that means, let me just scan or scroll down just a little bit right here. That means that 3-month interest rates are paying 5.6%, and 30 years are paying 4.3%. Traditionally, the inverted yield curve is with the 2 and the 10. That basically, if this is higher than this, this is an inverted yield curve. Obviously, you can see that that's the case right here. That has got to correct itself in order for this to be a healthy market, and in order for us, we still may run into recession. That there are some risks in this chart right here that we just absolutely have to be aware of when it comes to equities, because it just, at least in the last, since 1993 in this chart perspective, if I go to a market top, here's what a market top looks like, relatively flat to inverted yield curve. Here's a market top, even back here, this was 2007, inverted yield curve, market bottom, healthy yield curve, market bottom, healthy yield curve, market top, healthy-ish yield curve. Okay, this was going into COVID. COVID, we just, we had these amazingly low interest rates. Right here, they were flat. This was the COVID moved lower, and then interest rates just really got really low, if not zero, for a long time. Now we get this move, then we get a retracement, short end of the yield curve. This ends up creating an inflation. Okay, low interest rates and a ton of money getting pumped into the system creates inflation. Okay, whether the Fed knows that, and it just is the way that the economy works, the way it is designed, right, at least at this point. So we kind of have to follow the game. In this case, we've now got a really high yield curve. This is not the way market tops or bottoms should look. Okay, this is not the way the market bottom should look. The market bottom should look like this, should look like this, should look like this. Okay, so, and a market top typically looks more like this, more like this, more like right now what we're dealing with. So that being said, will history repeat itself? It typically does in some form or fashion. It kind of rhymes, so to speak. It doesn't always happen the exact same way, but that's a concern. This is a concern that if the market ends up deciding that inflation is not going away, and that could potentially create and these high interest rates could cause a recession, stocks are going to sell off. So that hasn't happened as of yet, but when we start to see a move like today, and we start to see conditions that we have, we want to be watching this equity move pretty closely. If it breaks that 515, if it breaks down through this support area right here, that's an area we want to be watching, and we could be getting shifting of trend at this point. And it can happen slow, it can happen fast, it can happen, typically the first beginning of the phase doesn't happen fast. It's when everybody starts rushing for the doors that can start to happen. Stock markets do not go up forever. It's felt great in the last 6-8 months, but we need a retracement at this point. Well, we don't need one, but we're going to get one along the way here. The further we keep climbing without a retracement, then at some point we'll just get a nasty one. It's just the way that the market work, and it's not going to be any different this time as well. Okay, so just that's kind of been watching for where we're at. This 1-year perspective gives us a little bit different viewpoint, but not significantly different other than the fact we can see where we've come. We can see since November, we've just had this really solid uptrend, and really this uptrend has not even been tested. We're just continually within this overall uptrend line, and that's an attempt at a test today. That really was the point that I want to make known right here. Now, let's talk about several ways to be able to manage a downturn in equities. There's really 3 ways to hedge. Okay, number 1 is cash. Okay, that number 1 is get out of equities entirely. That's one scenario to let's see, hang on, I'm getting a message here, my audio. I might have a little bit of an internet issue, but we'll keep chugging along here. Number 1 is cash. Okay, cash is paying 4.5%, 5% annualized right now with essentially no volatility. The trade-off in cash is inflation. I've mentioned this before, that if you're sitting in cash for too long, then it is going to erode your purchasing power. Sitting in cash for a short amount of time while you're trying to decide, which direction do you really want that cash to go to, but in the meantime, you would rather have it in a certain location, then that's you'd rather have it sitting in cash until you can make that decision of moving out of equities or readjusting your portfolio. That's one of the ways to do it, is just not being in equities at all. Okay, now the downside of that is long-term being able to outpace inflation and grow your assets at a pace that you need it to grow in order for to get the compound growth, to be able to grow that effectively. You're not going to do that in cash, but cash is not designed to be a growth instrument. It's designed to be a spending and safe instrument for that cash that you need now. You need it in the next 3 years. You don't want to have volatility with a certain percentage of your assets, especially if you're using it and spending it. Okay, so that leads me to the second thing. The second thing that you can do is allocate away from riskier equities or equities or equity as a whole and start to move some additional money over to cash. Okay, so in this case, 50% of cash, maybe a little bit more than that, would be warranted right here. And as that's happening, one of the things that happens at some of these shifts, and they can be a little bit uncomfortable, is as you're shifting over to other equities or sectors that are working. Okay, and that can sometimes happen quickly. That can sometimes happen slowly. For example, gold is starting to move, and it has been moving. And Harmony Gold was a trade that we got into back here in March. It started right here. It's continued to work. Now we've had some that haven't worked, and we've had others that have worked as well that are not gold or oil or something, but typically those, we start to see those start to shift. We start to see some of those stocks that have been big winners maybe start to rotate out. But now we've got Harmony up 23%. We've got a USAP, which is a steel producer, had a big move. That's a basic material stock. So again, not tech, not AI, it's steel, and it's moving. Okay, just like gold is moving, just like oil is moving. We're starting to see some of those shifts into some of those other categories. Now let's look at the stock that we went in with today. Let's see if I can find it. UEC. So UEC is another basic material, uranium mining type stock. You're starting to see those starting to curl back up. Okay, now as that starts, when I say curl back up, it had been in this uptrend, had gone through a retracement, and then starting to work its way back. That's what we want to start to see, is which stocks and which sectors are starting to move higher as equities are starting to move lower. Sometimes this strategy still is a little bit tougher to stomach because everything is so linked to indices now. When S&P 500 sells off, then SPY sells off, which is the ETF. And the mutual fund, the Vanguard's fund, sell off. And when those funds are selling, they have to sell all of the stocks that are inside of those indices. And so sometimes you'll just get everything going lower because the indexes are going lower. And that's a tougher scenario. And that's why, but the vast majority of time we want to be trading with the direction of the market. And in this case, this is one of the ways to try and get a counter market or be focusing on what is working. It's really more about stock picking in these environments, or as we're entering into probably a volatile time of year and circumstance on equities as well, that we want to start looking for lower position size stocks that are in sectors that are starting to work. We may start to see basic materials and mining. We may start to see consumer staples, like your Procter and Gamble and your Clorox and your Campbell Soup and some of those basic type stocks. We'll start to see those will start to show up in new buy signals as well. They'll also start to show up in your sector scans when we start to look to see what's leading. Construction has just been leading so solidly that the average rank of the group in that construction sector is 72. So that one's really been moving well. But we may start to see some of these that are moving a little bit higher. So consumer discretionary, if we were to take a look and see what we've got happening in consumer discretionary and see if there are any interesting trades that are moving in that direction. Consumer discretionary, what we would actually want is we would want to focus on consumer staples. Okay, so inside of staples, you're dealing with food, you're dealing with agricultural operations, consumer staples. Let's look at these 14 here and see what ends up pulling up here. Let's see if there are any Krispy Kreme, right? Krispy Kreme, don't know that that's a staple or not. Kimberly-Clark. Okay, so Kimberly-Clark, here's a good example. Kimberly-Clark consumer staples. These guys, Kimberly-Clark makes toilet paper and that kind of area of the economy, cleaning products. And so you're seeing a nice big move here. So that could be an area to start to be watching for. Things that people are going to be buying one way or the other, like food and hygiene products and those types of areas tend to be moving higher. Not necessarily soup specifically, but food type items, safer, consistent. Typically the earnings and the sales are relatively consistent because people just have to keep buying. We've still got to make that Sam's Club and Costco run. Okay, and then Kellogg's another example right here. Okay, moving nicely. So those are some areas to be watching for that. Actually may not be one of the areas there, but we can focus on. I don't know why this is loading a little bit slow here, but let's give this one just a second here and let this one load for the consumer staple stocks. See if we can get a good glance at some of these. Lifeway Foods. This is pulling in a few more. Vital Farms. So you're getting consumer staples, food products. We could go out to some of these other ones and find out exactly what they do. Go out to Google. I like to go out directly to their website and find out, okay, what are these guys doing? Okay, Vital Farms. Okay, they're pasteurized farm. What do they call them? Cage-free eggs. I actually like these. I actually buy this product too, so that's interesting. Eggs, okay, something as simple as eggs, and the stock price is continually moving higher. Consumer staples, that it's up 1.5% today. You're probably going to continue to see those type of things. So as you're looking at additional areas to focus on, then say what makes the most sense. Okay, what is moving. Okay, food items are moving. Colgate-Palmolive. Let's look at CL. Okay, a little bit more. Colgate-Palmolive. It's an S&P 500 stock. It might even be a Dow stock as well, to where it's getting, it'll probably move with the markets as well. So we continue to see those. They've actually done really well and more than likely will continue to do well. That's another way to allocate the portfolio. So my point with that is we're going from cash, larger positions of cash, and then rotating. In this case, we're rotating into what is working, what are beginning and continuing to work. Some of those as they start to take off, like some of our newer trades recently, they just haven't done much. They're not down big. They're not up either. They're just kind of flat, like Carvana. It's kind of had this, here's our entry bar, rally up, consolidation, not doing a whole lot. We're seeing that a lot more stocks that are creating a little bit more volatility, or they're just not getting the confirmation move higher that we would expect out of some of these patterns. But some of them are working, some of them aren't. That's just kind of the way things go. We are seeing some nice move here in ALAR. This is a tech stock that has been doing quite well and having another day again today. So there are pockets, okay? There are pockets of stocks that are working. There are pockets of stocks that are continuing performing. And that's ideally, if we're going to own stocks, those are the ones that we want to try and own. We just want to own less of them because we're going to get some volatility here. And you've seen that really, this number right here, we've gone from, 37 back to 33, 34, really hasn't moved a whole lot for the last 2 or 3 months, up and down and relatively sideways. Been a little bit choppier market as stocks are either moving. We had some real big winners in that biotech space, in the crypto space a few months back, and then we had some hedges that didn't work. We put on 2 hedges, the market kept going higher. We exited those. Okay, those are scenario where that was a loss that took place. And then we've had a few that stopped out. We had a couple of ugly earnings reports that we got stopped out of. Okay, those happen, but to be volatile down 3 or 4% in the last 2 months, that's the kind of volatility that I'm comfortable with this portfolio. Is we can have 2 or 3% days. And we can have 3 or 4 or 5 or even 6% volatility ranges, and that can also be more. That it's not. We're not subject to additional volatility in these other names just because we've got a larger amount of cash. What we are doing is we're making sure that our position size is appropriate so that when these stocks do have volatility, it's not all of them all at once, and it's not one that's going to take us out. Okay? It's not one stock that's going to really ruin us. We had an ugly gap down last week, and those hurt. Those really do hurt. But in this case, it was 1.5 to maybe 2%. It wasn't quite that much, but it was a pretty decent chop from one stock, and that stock gapped lower by 50%. Okay, so we can have those kind of moves. That was right here. 52% drop on that thing from a gap overnight from earnings. So the risk is always there. There's always a scenario, because we're trying to go. A lot of times we want these kind of stocks that have the potential to really make big moves. We're pulling out of this muscle stock group. We're working with some of these this upper range of stocks. We want to try and catch some of those as they're starting to move, because they have the possibility of making these big moves. They also have the possibility of giving it back relatively quickly. So we talked a little bit last week on how to avoid maybe looking for that aggressive of a stock by creating a screen we still got our live class screen here. Let me come. And then we also talked about, we had this beta scan. Let's look at that, Dave, and see if it's pulling anything interesting here. Interesting that it's Microsoft and Intel, right? Those two things, Frontline, which is a transportation shipping type stock, interesting there as well. So they're little less volatile. Microsoft's going to have some volatility, but it's not showing it as of yet. Microsoft, Intel, interesting trades right there showing up. So that's one. Again, we can control our scans that we are willing to invest in and to trade based on some other criteria. We're still looking, in this case, we've got our settings here to pull in really high market cap, large volume. It's got some earnings, okay, and we can do that. And I've got several that I've set up. I like this 555. This pulls up some nice stocks because it's giving ROE, annual EPS, last quarter EPS, and sales. Those are those high octane numbers in growth companies that need to be working for those companies, and a lot of them are. You look at some of these that are cruising. In fact, there's our Vital Farms again. That's been a good looking stock, and it's really profitable, and it's growing. Okay, so interesting that eggs they probably have more than eggs as well, but it's like, man, that's, that there's no servers, and there's no tech risk, and it's just flat out people eating food. And these guys are selling a lot of it, and they're moving. A lot of consumers are moving more to that organic, healthy, farm-based food products, and you're seeing some of these individual farms that are popping up. Dick's Sporting Good has also been a big mover here. It's probably due for a pullback. It's definitely got some range back to that 236 that it could retrace back there as well. So Van Heusen has also been. Oh goodness, they had an earnings gap today. It looks like. There we go again. Just see even Van Heusen. Okay, have shirts, white shirts and ties having some volatility right there in even some of these big large cap names. So we want to be able to make sure that our risk is particularly allocated by utilizing smaller position size. We're going to deal with gaps. We're going to deal with some stocks that go up, some stocks that go down. Okay, and for example, just today, we're getting a real nice move out of this ALAR. We'll see how long that continues to run, but this is the way it should work. Okay, when it doesn't look like this, that's when we want to start breaking things down or selling some of the position or making sure that our stop loss is in place. Because when it works, it works. And sometimes it might just, 5, 6, 7 stocks that don't work in order to get a one that gives us a real big winner. And it's typically not that many. We usually will get, start off with, this is usually how they start off. They might flounder around right here, ELEV, nice looking pattern, aggressive trade, obviously, but it's moving. Big volume days working there today. We'll see which direction that volume takes us. That's a biomed stock. Some of those biomeds, they're still working. The world doesn't come to an end, right? Just because interest rates are high or inflation is high or the stock market is high. This is, individual companies are doing what they do, and there's going to be amazing things that happen in the economy and in AI and in some of these names. And we've just got to be able to try and take some of these trades in and be able to do that in a way that is not putting a lot of risk on the table. Okay, that's our biggest area of concern as investors and traders is risk, okay? And that is loss of capital. The volatility in a portfolio is pretty normal, but that also can be controlled by position size. Position size, notice some of these slivers and these pies right here, they're getting kind of smaller. That's a 1.5% right there, 1.5% right here. We're getting a little bit smaller in our position size. I trimmed half the position in CLS today. Okay, so we're back down. We took off a certain number of shares, about half the position in that case. We went from 80 to 40. Okay, so we're still getting the gains, but now we're getting smaller position sizes, just in case this thing continues to move higher. Okay, it's kind of flat right here. We'd had a nice gain. We bought it right here. We've now dealt with most of this retracement. We'll see if it turns higher, but if it doesn't, we're going to at least take half of the position and call it good and leave the other half and let that run. And then we'll put on full positions on our newer trades as they start to develop. So, and then the last thing that I just wanted to cover quickly, and that is inverse ETFs, trading them like stocks. If we go out to our watch list and we go to our sector ETFs, we've talked about these. These are leverage, triple leverage. You don't have to do triple leverage. You can just do a traditional leveraged. Maybe I'll add those in for Thursday as well, and we can talk about that. But this is a way to be able to buy something long, meaning all I do is I just buy the shares, just like a stock. But if the stock market, if the S&P 500 drops by 1%, then this is going to go up by 3%. Okay, so S&P 500 drops by 1%. This is going to increase by 3%. So it's a way to hedge a portfolio, or just flat out trade a downward direction. You can trade that direction. You can do it either as an additional position or as a fraction of the cash that you've got, and say, okay, I'm going to put of the cash that I've got sitting here, I'm going to put maybe 5% of that, or I could even do the same 2 to 2.5% into a trade like that, and treat it just like a trade. As a pure hedge, you could certainly do it a little bit larger, but that's also going to be a little bit longer time frame to hold on to something like that as well. But those are also ways to be able to reduce your risk. So really the three that we've talked about are going to cash. Okay, there's pros and cons to doing that, being 100% in cash, and I should say going a cash position size balance, so that you've got, say, maybe 20 is too many right now. This is a natural process to where it's just we're either adding or we're selling or we're reducing, and we're doing that daily. So, and this ends up being about the average. Those of you that have been with me now for length of time have seen this. It holds about 20 holdings. When things are really moving well and all of the positions are working and all the positions are doing well, I think we got up to about 28 holdings, and we ended up with only this amount in cash, and we had a bunch of positions here as well. This was about 2.5 months ago. So right now it's, market conditions are either naturally the trades are not going higher, they're just not working and they're flat and we're stopping out, or they're just, or they are stopping out, or they're kind of flatlining, okay? Kind of like CLS right here. It's still working, it's still moving, but it's been doing a whole lot of this. Really the entire month of March has kind of been doing that for a handful of trades. So, and then the last thing of the three is to utilize an inverse ETF to be able to trade something, own something that is going up when the market is going down. And you can, when that starts to happen, you're going to see a boatload start to show up here in the muscle ETFs. So keep your eye on this muscle ETF list. Sometimes it's getting kind of cluttered, in my opinion, with some of these, like the 1X. They have ETFs now that'll 1X one stock, like a Microsoft. I think that's dumb. Okay, so it's but there's always some, like right here, daily Amazon 1.5X. So you're getting 1.5 times what Amazon is doing. Okay, that's fine, whatever. It's like if you need an extra 0.5% over and above that, then great. So it's just a leveraged way to do that. They're going to show up here. Keep an eye on some of those. You might find something that's interesting in other areas as well. In crypto, you're going to start to see some of these grayscale crypto futures. You're seeing FANG stocks. You're seeing, keep an eye on that, see what pops up. Now you're seeing oil and gas, 2X oil and gas, Gush. Okay, so a leveraged ETF, Gush moving higher. Keep an eye on that list. It's an interesting one, if anything else. And you can start to find some things that either are working or not working. Uranium miners right here. This is interesting. Okay, so we went with UEC today. If you wanted to own uranium miners as a group, URNM may be a way to be able to participate in the entire group without having to just have one specific stock. The group can certainly be volatile as well, but URNM, that's an interesting ETF. Just seeing the strength in that yesterday and knowing that money is starting to move back over into basic materials, mining, oil, anything that comes out of the ground is moving higher right now. So we'll keep an eye on some of those stocks as well. That's going to do it for today's update. I sure appreciate everybody's time and effort, and have a fantastic day today. Thanks a lot. Bye now.